Hello and welcome to the lecture on your operations plan. So this lecture is going to cover the basics of how you run your business and how that will be conveyed in this segment of your overall business plan. I'll also talk about the importance of facilities, supply chain, which we have talked about before a little bit, inventory control, and then contingency planning. So the operations section of your business plan doesn't need to cover every single thing that you do. You don't need to give a step-by-step plan of how you make your product and those sorts of things. Just the key points, the things that are maybe different or unique about your business or very important to businesses in your industry that a reader would be looking for in your plan. It's important to highlight things that give you a distinctive competitive edge. So if you are controlling your own raw material source, that's a competitive edge over your competitors. If you have some form of production technology that's different than your competitors or maybe kind of leaps ahead of them in some way, that's important to describe. If there is a problem in your industry, a problem either with the source of supply, a problem with technology, a problem with licensing or labor or supply chain management that's well known, that's covered in industry literature, make sure that you address how you're going to overcome that particular problem, because chances are your reader will be aware of it and will be looking for you to make some statement about that. So that's important. So here's a suggestion I have that is outside of your business plan. So this is not part of your business plan or the segment that you'll be uploading for this section. And that's to have an operations manual when you actually start your business. So it should have specific details of everything that's involved in every step of running your business. So it can be done with a 3-ring binder. It would include things like procedures for inventory control, like how do we receive inventory, how do we consume inventory, how do we take cycle counts, how do we make sure our inventory is correct, how do we protect our inventory, a list of equipment that we do routine maintenance on. And part of the thing here is that you can't hold employees to a standard that you don't make clear to them. So you're really doing your employees a favor if you give them explicit instructions. If there's any software involved in what your employees are doing, having screenshots of what they would see as they're using that software is important. So kind of make it as detailed as possible, and don't reference people's names in it, reference positions. That way you don't have to update it every time somebody joins the company or leaves the company. So this is a good thing to have on hand once you actually start your business. So a couple things about facilities. For those of you that are thinking of retail type settings, where customers come to you, your location is going to be very critical. And a couple of things to consider there. Is there room for expansion? So if you start out with a small operation, can you take over another segment of the building? Can you expand the building? And then the key thing is who pays for that expansion. That should be agreed upon up front. Most of you will start by leasing a facility as opposed to buying a facility. So how flexible are the terms of the lease? How easily can it be either expanded or reduced? Can the term be changed? What is the language about increases in rent or lease payments over time? Is it pegged to inflation or some other amount? Leasehold improvements, those are all the improvements that you make to a facility to make it work for your business above and beyond how it is when you first arrive there. For retail locations, that's especially important because you want a certain look and feel in your space there. And the key thing there is who pays for that. If you make improvements, are you allowed to take those improvements with you later, or do they become the property of the building owner? So those are, again, all things to agree upon up front. Some leases include utilities and building maintenance. Some leases charge extra for that. If you happen to be in a strip mall kind of location, there'll be charges for maintaining the parking lot and vegetation in the parking lot, things like that. So find out what those details are, how much you charge for that, are you charged for that, all kinds of other things. Another thing to keep in consideration is what other tenants are going to be near you. So you obviously don't want a direct competitor to be right next to you, so that's something that has to be negotiated in a lease. So if you don't think to ask for it, then the landlord is free to lease to anybody they want. But you could, as part of the negotiation, get the landlord to agree to restrictions on the type of other businesses that you want nearby. And then the last thing I'd think about in terms of facilities is the site that you're choosing going to offer you advantages or disadvantages relative to your competitors. So that could be convenience, it could be kind of street appeal, or does the facility kind of reflect the image you want for your business, traffic patterns, all of those kinds of things. So think about it relative to the people that you're competing with. Now, all of you are going to produce something. Some of you are just producing a product. Some have a combination of a product and a service where you offer entertainment or experiences for customers in addition to the product that you're offering. So that's going to involve labor, and you have to make some decisions about how you're going to handle that. So you could choose to hire employees. And in that case, you'd have to think about what their compensation might be. So most employees that are not supervisors or professional staff need to be paid hourly, and they need to earn overtime. That's the law. So how are you going to hire, I worked for one guy one time that says if you pay peanuts, you'll end up with monkeys. So, are you going to have low pay and churn through people, or are you going to pay a little bit above market and attract really good people that might be more loyal to you? So those kinds of decisions are important. Of course, if you pay employees more, that's going to cause your product to cost more as well. And all of this will be reflected in your business plan or the financial portion of your business plan. One thing I would be careful about is hiring friends and family. The advantage of hiring friends and family is you kind of start out with a level of trust and knowledge about each other, and that can make things easier in the short run. The caveat to that, though, is that you shouldn't hire anybody that you wouldn't be willing to fire. So if you wouldn't be willing to fire your brother, and suffer the consequences to family dynamics that would entail, then don't hire your brother. So you can't bring people on that you wouldn't be willing to let go. A couple of other things. Temporary labor, depending upon the skill involved, that can be a way to kind of try employees out. So in my factory for Big Toys, I had some entry-level jobs that were fairly straightforward, running a drill press or a cut-off saw or something like that. And I would often hire employees through Labor Ready or one of those other labor agencies. And I could specify the kind of person that I wanted them to send me in terms of skills or drug tests or whatever the case was. And then they would send me a bill for that person's time. And you pay a bit of a premium for that, of course, because they're managing it. But it allows you to kind of try people out. And then if they don't work out, you just call the agency and say, don't send that person again, send somebody else. So it's a kind of a relatively low cost way of dealing with that. And if you like the person, then there's ways to convert them over to a full-time employee of your own. So that's a good way to kind of wade into things. And it's especially good if you're going to need more labor for short bursts of time. Maybe during canning operation you need 4 extra people or something like that. That's a good way to get those extra people, but then not have them standing around all the time getting paid when you don't need them. So the other thing to look at is subcontractors, and that's a way to use outsiders. And again, canning and bottling is one example of using a subcontractor. Somebody comes in with their own employees, does that operation for you, gives you a bill, and leaves. And again, that's a good way to handle those kinds of things. In a lot of cases in a small business, that you need certain expertise for a short amount of time. You don't need a full-time lawyer on staff as an example, but from time to time you need a lawyer. That's an example of a subcontractor. Same thing with a tax accountant. You don't need a full-time tax accountant, but when you have tax questions, you need somebody that you can reach out to. So those are examples of subcontractors. So a little bit about supply chain considerations, and this is certainly all over the news now. You hear about all the problems in the supply chain. So some things to consider, first and foremost, is the quality of the product that you're getting. It's foolish savings to get a low quality raw material and pay a lower amount for it if it's not going to work out for your product or cause your quality of your product to go down. Price is certainly a factor as well, and that's the all-in price. So it's the price after factoring in any discounts that you receive and considering freight to get to you and all duty potentially if it's coming from another country. So it's all of the landed price at your facility is what needs to be considered. Distance from you, there are two factors involved there. One is the cost of freight and getting it to you. The other is the length of time it takes to get to you that you have to factor in. And then minimum order levels. So some suppliers don't want to mess with a small order. They only want large orders, and that may put some limitations on who you want to order from. So the relationships that you have with your first tier suppliers, those are the companies you buy directly from. And then the lower tiers would be the people that they buy from, right? So there's multiple tiers in a supply chain. So it's important that you have close relationships with those first tier suppliers. Regardless of how you feel about those people personally, they need to be your friends because friends do favor for friends. So if you need somebody, you get a big order and you need your supplier to work on the weekend to get you something so you can fulfill a big order for one of your customers, you need to be able to call that supplier and convince them to do that. And that's easier if you have a good relationship with them. So visit with them, take them out to dinner, whatever the case is, but make sure you have a good relationship with those people and work on that. You want to definitely talk to your suppliers about the reliability of the deeper tiers. You don't want them to not be able to supply you because their suppliers can't supply them. So you have to reach some level of comfort about that. As with any business relationship, it's important to have agreements. So talk to your supplier about what your expectations are, what their abilities are, and document that so that both of you have it in writing. To the extent that you can talk about things in advance and document them, you'll have fewer disagreements or arguments down the road. The other thing I would say is to continue to evaluate your suppliers. Many people will do an evaluation to choose their supplier initially, and then they don't revisit that. They just keep buying from that supplier. Well, that supplier may develop bad habits over time of not meeting your quality expectations, not delivering on the time they say they're going to, raising their prices, increasing minimum order levels. They could change things about how they do business with you. In some cases, it's because they take you for granted because you're an existing customer. So it's a good idea to at least annually evaluate your suppliers in an as objective way as possible to say, is this still the best person I should be dealing with? And then lastly, outsourcing is a decision that just about every manufacturing business will make is what should we do internally and what should we have somebody else do? A lot of times that's an economic decision. In the case of my business, it was economic, but it was also influenced by my desire to offer a broader array of choice for my customers and a shorter lead time for my customers. And that required me to do less outsourcing than other companies might have done. So that's something to consider. Inventory control. So there's positive and negative things about inventory. So the cost or risk of having too little means that you're not able to supply your customers when you say you're going to, and that can lead to a loss of business and those sorts of things. The risk of having too much is spoilage. It might go bad and you throw it away. That's money down the drain. The more inventory you have, the more storage space you need, the more people you need to hire to look after your storage space. You might need equipment at that point and all of that. You have to insure your inventory. That costs money. You might finance your inventory, which costs you interest. And the biggest risk of having too much is that it ties up your cash. You can't pay your employees with inventory. You can't pay your bank loans with inventory. So having your cash on the shelf is not a good position to be in. So the key thing is having the right amount, kind of finding the sweet spot there. And for that, you really need some kind of information system that lets you look ahead to what your production plans are and anticipate what your inventory needs are so that you can do that correctly. So one of the things about quality control, a lot of times quality control or quality, people think of it as being, kind of the highest level of quality is having the best features, the best characteristics of the material and all of that. And I would argue that quality should be looked at as what do you promise your customer and how close do you come to delivering that. So there are organizations like ISO, which has an ISO 9000 certification, and that's what it's intended to signify. That not that it's the very best product that you could get in that category, but that it is consistently what customers are getting what they are expecting. In that definition, I would say McDonald's is very high quality. Not that it's the best food in the world, but that you can go to any McDonald's anywhere in the world and you're going to get exactly what you expect to get. And that's certainly a measure of quality. So that's something for some of you to think about in your business. So distribution, I think many of you will require distribution of your product. You're not going to sell all of your product directly to end consumers. And so that requires you to go through middlemen or wholesalers or distributorships, other kinds of organizations. So you want to try to choose distributors that match your target market best. So if your goal is to get into high-end grocery stores like Whole Foods and those kinds of places, then you want to make sure you choose distributors that have relationships with those retailers. So you can kind of work backwards by asking the retailer, who do you get your product from, and find out the distributors that work best with them that way. To the extent possible, you want to try avoiding putting all of your eggs in one basket. That way, if something goes awry with that relationship or they find a product that they think is better than yours and they replace yours with it, you're not sunk. So if you can have multiple distributors, potentially in multiple geographic areas, you can kind of weather that setback much easier. And then, as with other suppliers, you need to monitor and change distributors when necessary. If you don't think they're doing the job for you, you need to pull back and make a change. Hoping that things get better is never a good strategy. So order fulfillment and customer service. So all of you are going to be involved in this activity. And the key thing there, and I put it in red there, is to under-promise and over-deliver. So make sure that you pleasantly surprise customers by doing something a day sooner than you said you were going to do it is a really good strategy. Make sure that you train, recognize, and promote employees that interact with customers in the way that you would if you could do all of it yourself. So all of you have an idea of how you want customers to be treated, and it's really important that you attract and promote and retain employees that act in that way, and that you're clear with them about what your expectations are and how customers should be handled. It's not going to happen naturally, so you need to make it happen. Also, you should build flexibility into your policies so that employees can do whatever's necessary to get somebody to come back and buy from you again. And sometimes that means violating a policy if it's in the interest of a customer. So again, you need to kind of think about that and take that into account when you're training people. Last thing I talk about is financial control, and that's having procedures in place that make sure that all of the financial transactions in your business are handled accurately and promptly. You want to make sure that you have controls in place to prevent fraud. Those are called internal controls, and happy to speak to any of you about that at greater length if you have an interest in that. And one thing I'd recognize is cash is king in a small business. So you can be profitable, But if your cash flow isn't healthy, meaning your cash is getting tied up in money people owe you, or your cash is getting tied up in excessive inventory, then you're not going to be able to pay your bills. And at the end of the day, not being able to pay your bills is what's going to cause your demise more than any other factor. So be very cognizant of cash flow. And I had a calendar in my business and on each date in the calendar, I would say, what do I know is coming in and what do I know I have to pay out? And I would keep a forecasted running balance of my checking account just to know, is it going to go negative at some point? And if it is, what do I need to do today to avoid that likelihood in 3 weeks or whatever the case is? Sometimes that meant putting off buying something to ensure that I would never go negative, but that's a critical thing. And the other thing I'd say is make sure that you get constant information from your financial system. So a lot of accountants kind of work in the mode that they produce monthly financial statements. So if you want to know how we're doing, wait until the end of the month and I'll give you a set of financial statements and you can look at that. Well, you have a right to expect more than that. And I would require information daily. Some of the things that I got daily from my system was the level of sales every day. So what orders were received, what did we ship out, so all of that. And then I focused a lot on cash, how much cash came in, how much cash disbursements were made, so how much cash went out, and what is my balance. So knowing those 4 things, how much did I sell, how much cash came in, how much cash went out, what's my cash balance, knowing those 4 things every day would be critical for any business. So thank you for your attention. I look forward to talking to you in the next lecture. Thank you.